Donald Trump wrote off his hairstyling fees for about $70,000 and Ivanka Trump's $100,000 of hairstyling fees during The Apprentice. Why? Because Donald Trump said that he has turned himself into a brand and therefore maintaining his hair and his appearance is a necessary and ordinary part of his business.
There's so much nonsense that he just spewed out there that the only way I'm going to be able to address this is if we go step by step. He's under audit. That should tell you what happens when you deduct dubious expenses. And this is not the first individual who's tried to deduct amounts related to his image, his brand, and so forth. And there have been a plethora of tax court cases, of guidance put out, and all this other stuff that makes the case that for the most part, all of these expenses that have a significant personal element are not deductible as a business expense. If you're getting a manicure, if you're getting makeup, if you're getting plastic surgery, things like that, and you try to justify it as a business expense, you better make sure that you cross your T's, dot your I's, because in many cases, those sorts of personal expenses are not deductible for income tax purposes. So you can't rely on somebody who's being audited and say, hey, look what they did, let's do that too.
The worst thing the IRS does if you take a deduction for something and then the 1% chance that you get audited, the IRS says, bad Timmy, bad Donnie, you shouldn't have taken that write-off, you shouldn't have done that. You pay a little bit of a penalty and you pay the tax on it.
Okay, let's take a closer look at what he just said. A little bit of a penalty, then you pay the tax on it. Okay, so let's take a look at this IRS fact sheet. This talks about some of the penalties that are applicable to taxpayers, and we're not even talking about the state level. So there are late filing penalties. So if you don't file your return by the due date, including extensions, this is a 5% penalty for each month or part of the month that a return is late, up to 25% of the total tax. Then you have the paying tax late penalty. This is 0.5% per month, generally also limited to the 25% cap, but up to 25% of the taxes due can be paid out just for paying and or filing late. Then we have accuracy-related penalties. The two most common accuracy-related penalties are the substantial understatement penalty and the negligence or disregard of the rules or regulations penalty. These penalties are calculated as a flat 20% of the net understatement of tax. That's in addition to any late filing or late payment penalties. So we also have a penalty for substantial understatement. You understate your tax if the tax shown on your return is less than the correct tax, and so on and so forth. There's some thresholds here. There is also the civil fraud penalty. If there's any underpayment of tax on your return due to fraud, a penalty of 75% of the understatement due to fraud will be added to your tax. All right? So some of these penalties relate to the total taxes. Some of these penalties relate to the total amount of understatement. But you can see how this can get ugly very quickly, yes? Frivolous tax return penalty. You may have to pay a penalty of $5,000 if you file a frivolous tax return or other frivolous submissions. All right. And this doesn't even have to do with any of the criminal matters that can get involved with taxes, because if you Google didn't pay taxes, IRS, jail, you'll find exactly what I'm talking about. All right. This is not a joke, not a game. And him saying that you get, just a little bit of penalties, a little bit of interest. That's not the case. All right. Because it can be extremely substantial. If you're looking at payroll penalties because you didn't take reasonable compensation as an S corporation shareholder, those penalties can be even uglier and more massive. And this could be life-changing from a perspective of not expecting all this tax trouble, and then all of a sudden it comes avalanching down on you, all right? Be very careful about this sort of advice.
See the difference? See what, the difference between rich person and criminal is? It's pretty gray.
It's not gray. It's not gray. These rules are very well established, and even celebrities have gone to jail for tax evasion and tax fraud. And for an example of what I'm talking about, let's take a look at this person. Recognize this guy? You should, because that's Al Capone. And what did he go to jail for? Let's take a look. In 1931, Capone was convicted after trial on November 24th and was sentenced to 11 years in federal prison, in addition to $215,000 plus interest due on back taxes. Just a little bit of interest and penalties. And you can see here that even Al Capone pled guilty to tax evasion and prohibition charges. That is really what did him in when all was said and done. So if it can happen to Al Capone, it can happen to you.
I'm not saying break any laws. This is just simply rich versus poor. How America screws you. That's all I'm doing. I'm not encouraging anything illegal. Don't do anything illegal. Do not do anything illegal.
How do people watch this guy? I can't even make it through this video. I'm having trouble. Oh, man.
But here's just an example of what some rich people like to do. Let's say some dude takes a $10,000 vacation with his family to Ibiza. And he is a day trader, so he shares photos on Instagram of him with his laptop day trading. Yay, look at me, I make money while I'm vacationing in Ibiza. I set my call options and my stride, Boom. Now all of a sudden, this person might be promoting their day trading course or their day trading book or whatever it is. They're selling the lifestyle of a day trader, which might be a necessary and ordinary advertising expense for a day trader. And boom, all of a sudden, this person just wrote off a $10,000 business expense against their income. Whereas the poor person spends $10,000 on vacation they saved up for and they don't get any discount from the government.
Okay. Again, this makes absolutely zero sense. Why would a vacation where you're spending time on the beach trading stocks be ordinary and necessary as a business expense for a day trader? I mean, this makes no sense. This is such garbage. I can't even explain this to you. There is no business expense there because taking an exotic vacation, especially with your family, and day trading on the beach is not ordinary and necessary for day trading. Now, you might try to make the case, if you want to really push this and be creative, again, with the quotes, that the beach helped you maximize your trading and all of that. I wouldn't take that position, okay? It gets very much into the fluffy, this helps my chi and my third eye and all this nonsense. So, again, has nothing to do with the day trading business. It may have more to do with a YouTube business. So if you, let's say, are taking a trip where the main purpose, the main driver, and you're going to spend most of your time legitimately, not air quotes, but for real, focusing on whatever business you're engaged in, whatever YouTube channel, like if it's a travel channel or something like that, then you may be able to make the case that those expenses are indeed deductible in full, assuming you spent the vast majority of the time when you're abroad, when you're away, on those business activities. So that would lend itself to being possibly deductible. But in terms of deducting the vacation because you're a day trader and making the case that it's ordinary and necessary, good luck with that. I wouldn't touch that with a 10-foot stick. I wouldn't touch this guy with a 10-foot stick. And why hasn't he cleaned this suit, okay? There's a spot over here. It's bothering me. Look at this. You got to clean your suit, man. It's driving me nuts. Anyway, let's continue.
Rich people buy real estate to lose money. They're actually losing money on paper, while at the same time, they're actually socking away loads of cash.
Okay, let's dissect what he just said. When you have rental income, that income is considered passive income in that it's a passive activity by default. There are some different treatments available, but by default, the rental activity is passive. So the income and the deductions are passive. What does that mean? If you have losses from a real estate activity, then you may not be able to offset the income you have from wages, from dividends and interest and all those other things because that income is non-passive. And if you wanted to deduct passive losses against that, there are some rules in place that would limit or eliminate your ability to take those losses and offset non-passive income. So if your AGI is less than $150,000 in a particular year, then you can deduct up to $25,000, and there's a phase out and all this stuff, but in general, there's a deduction available of up to $25,000 if your AGI is less than $150,000 in a particular tax year. In that case, you could deduct up to $25,000 against your non-passive wages, business income, things like that. But if your AGI is over $150,000, then you're not getting any deduction in terms of losing money from real estate in that current tax year. Instead, the losses are suspended and carried forward as suspended passive losses to be used when you either have enough income from passive sources or you have a complete disposition of a passive activity. I know I got kind of technical there, but at the end of the day, what he's saying is that you can lose all sorts of money on the real estate and then deduct that against your other income. If your AGI is less than $150,000, then to an extent, that's correct. You can deduct up to $25,000 in a particular year if you actively participate in that real estate activity, which is a specific definition in and of itself. But if your AGI is over $150,000 in a particular year, then what he said right now is absolute nonsense and does not apply to you, because by losing money on paper in this scenario, if your AGI is over $150,000, then in the current tax year, you're not making any difference in your tax liability. Okay? So just keep that in mind.
People control assets that go up in value and take advantage of tax benefits when they buy stuff that doesn't go up in value. Instead, the tenants have the mentality of, oh, but landlord, I need a new stove. It's broken. Landlord has to buy a new stove. Sucks for the landlord. I don't have to spend that money. It's like a concierge service. They come in and put a new stove in.
I'm sorry for putting you guys through this video. This guy is making my blood boil. I'm sitting here trying to watch it, but not watch it at the same time, if you know what I'm saying. So apologies on that. This guy's a super clown, but let's get through this and address more of these misconceptions so we can clear this up for the people out there. Yes? It's for science at the end of the day. All right?
Landlord goes, okay, no problem. Here's your new stove for $500. Got $50, call it $75 for the plumber to install it. And guess what they do? They put that on their credit card to get the 3-year extended warranty on it. They get the credit card points, and then they 179 section of the tax code write that sucker off.
Now, he's throwing all sorts of fancy tax terms around trying to sound like he knows what he's talking about. But Section 179, while yes, it may help you take certain deductions in a particular tax year, one thing to remember is Section 179 is limited, so you may only have a certain amount that you can deduct. If you're installing something minor like a stove or an oven in a rental unit, instead of taking Section 179, you may use de minimis safe harbor to deduct those amounts if the individual invoices are $2,500 or less for taxpayers without applicable financial statements, whatever, what have you. But by using the de minimis safe harbor, you don't have to use up your Section 179 that's limited. So you can maximize your Section 179 and also take the de minimis safe harbor for all of those expenses below $2,500. So if you have ovens that you added to all your different rental properties, if each one, based on the invoice level, is less than $2,500, then you can have massive deduction there and not have to tap any of your Section 179. So that's the difference between somebody who knows what they're talking about and can be strategic with all these different tax provisions and someone who is a total clown on YouTube who has no idea what he's talking about, has never filed a tax return in his life. So when you hear Section 179, just understand that there's a few different provisions that you can take advantage of. There's Section 179, there's bonus depreciation, and there's also the de minimis safe harbor in some situations that can be extremely helpful in decreasing your tax bill.
Number 7. Poor people say, wow, our family of 4 makes $50,000 a year. Yeah. A rich person who also makes $50,000 a year. So this is how you can, here's a difference, making the same amount of money here, okay? The rich person says, I make $50,000 a year with my family as well. But I run it as an S corporation. So instead of taking $50,000 in income, I pay myself $10,000 a year in payroll, and I take $40,000 a year in distributions. So I save $6,120 per year in payroll taxes.
Okay, this is probably the most dangerous and stupidest thing he said in the whole video, believe it or not. The concept of reasonable compensation when it has to do with an S corporation is one of the most hotly audited areas in all of income taxation. All right? If you really want an audit, this is the way to get it. In terms of having income from an S corporation and taking a salary that does not reflect reasonable compensation and taking the rest of the money as distributions. What he's suggesting is extremely dangerous and should be avoided at all costs. If you have an S corporation, you need to take a reasonable compensation in order to avoid issues. And you can't make the case that, oh, I have $1 million from the S corporation in net income, and I'm going to take $10,000 as my salary and the rest as distributions. Can't do that. You're going to have a bad time. You need the salary portion to represent reasonable compensation. In his example, reasonable comp could be $40,000. It could be $25,000. It really depends on the facts and circumstances. But if you're a single individual just working in an S corporation, it's difficult to make the case that the reasonable comp is any less than a substantial amount of that net income, because at the end of the day, it's your blood, sweat, and tears. Because what the IRS can come in and do is reclassify all those distributions, again with the air quotes, and treat them as if they were salary. So now you have delinquent payroll taxes, you didn't deposit the amounts on time, so you're going to have penalties based on that as well. It can get extremely ugly very quickly. Don't do what he's saying. This is the stupidest thing he's said so far.
You have to be self-employed and making income. You can write off your health insurance premiums. So if you're working a job and you have to pay your own health insurance and you don't have a side gig, you're not able to write off your health insurance premiums.
Again, incorrect. When you're an employee and you have a health plan that's offered by your employer, the premiums that you pay, the part that you contribute towards the cost of that health insurance, is provided to you on a pre-tax basis. Look at your paycheck stubs. Look at your W-2s. You're going to see that the amounts that you contributed towards your health plan are not being taxed. So you're contributing to them on a pre-tax basis. What is that also known as? A write-off. It just doesn't happen on your tax returns. What he's saying is that as an employee, you can't deduct it, but as a self-employed individual, you can. Wrong. And where is he sitting? Is he in a kid's room somewhere? Why is it purple? Why is there a guitar here? I have a lot of questions, okay?